Hello everyone, and welcome to a very apparently rainy and windy 1st of December, where we are going to be starting Lesson 6 of Unit 1, Area Study 1, Thinking Like an Economist, VC Economics. And we're going to be looking at the ACCC, or the Australian Competition and Consumer Act today, what it does, how that impacts on business behaviour, the kind of things that it prevents them from doing, and looking at a few examples of times businesses have competed in a way that is unfair or anti-competitive, and how the ACCC exists to prevent that from happening. So when we look at our key knowledge, it's all about the nature and effectiveness of strategies businesses may use to increase profitability, such as price discrimination, multiple branding, or illegal anti-competitive behaviour as outlined in the Australian Competition and Consumer Act of 2010. So this is some very messy highlighting, but let's get right into it. It's not too much, so we'll get through it pretty quickly. So the Australian Competition and Consumer Act of 2010. This is legislation set out to prevent businesses from acting in a non-competitive way. So you need to know about this. So you need to know it by name. It's very, very important. And then we're going to look at 8 different anti-competitive behaviours. If I knew what 8 was, 8 is that. Realistically, and types of questions you'll get asked in a multiple choice question, you could get given specific, like if a business is doing this, what type of anti-competitive behavior would it be? But more likely than not, you're going to get like explain 2 forms of anti-competitive behavior and how that the ACCC, or the Australian Competition and Consumer Act, tries to prevent. So we're going to explain 8 of them. If there are some that you feel more confident with, definitely just go with those. Take notes on those ones and potentially pretend the other ones don't exist unless you need them for other purposes. So there is price fixing, which is where businesses collude to set an agreed upon price. This was a situation that occurred kind of between the airlines many, many years ago. There used to be 2 main airlines. There was Qantas and Ansett. And this is like before your time, unless you're a teacher watching this. And these 2 airlines worked together to set prices high. And then that meant that consumers had to pay higher prices, and it was worse for everyone overall, except the airlines who were getting a lot of profit. This is where businesses collude to set an agreed upon price. Obviously, that's not a good thing because that's unfair to consumers. There's price discrimination, where different people have to pay different prices. This hopefully isn't as much of an issue in Australia anymore. There used to be issues where businesses would charge people of specific races different prices, or if they're a different gender, different prices. It still sometimes happens in trades where, say for example, a mechanic might quote someone who looks like they know what they're talking about a certain price, and someone who looks like they have no idea a much higher price, which is not okay. There's exclusive dealing, where businesses refuse to supply one or more firms. And honestly, this still kind of happens a lot. Like businesses are often paying to get exclusive brands in their stores and preventing other stores from having them to maximize their sales. But essentially, a business can't prevent or just not supply to certain businesses unless they've got a valid reason to do so. We've got exclusive bidding, which is where firms secretly meet to set a price specifically for one firm. So when it could be all the businesses decide that they'll give everyone one price except this one specific business, they're going to charge a much higher price. Then our last few, there is price leadership. So where the dominant or leading firm sets a price that others follow. So my example for this, I always love for an example, is like Slurpees or Frozens. So a couple of years ago, McDonald's made Slurpees $1, or frozen Cokes, as they like to call them. And then what tended to happen, every other business, so KFC, 7-Eleven, etc., they all followed on because they felt like they had to match that price. Otherwise, they'll lose business. And depending on what their margins are, they might be making less profit because of that, or losing money depending on what's happening there. So they needed to do it, otherwise they couldn't compete with McDonald's who did it. There is predatory pricing, which is where a dominant firm sets an unfairly low price to hurt their competitors. This happened with Coles and Woolworths a couple of years ago. I think it would be 3 or 4 years ago now. In the market for petrol, Coles and Woolworths had a deal going that if you spent $100 in their supermarkets, you could get 20 cents a litre off petrol. And if you looked at any of the other independent things beforehand, it was like maximum discount they would give on petrol is 4 cents a litre, and then independent petrol places just have to charge what they can charge. So the issue with this is Coles and Woolworths were selling their petrol at a loss because they knew they'd make the money back on groceries. But their whole purpose of it was they were trying to negatively impact the independent businesses they'd be taking business from. So they were essentially attempting to put independent petrol suppliers out of business, so then they would get control of more of the market and they could keep prices high. There is market zoning, which is when firms split up the market into territories each can sell in, saying that I'll have this suburb, you have that suburb, and we will only sell in these certain ones. That's not okay. And then interlocking directorships, when someone is on the board for both the company and its rivals, not great. That's going to obviously mean they have kind of ulterior motives. They don't want both companies to do well, and they might collude to make prices higher. So this is all enforced by the ACCC, and essentially, when there are breaches of these, it often leads to fines, and they're usually quite large fines, like it can be in the millions of dollars. So for the most part, the ACCC tries to do it and incentivize businesses not to do this behavior because there's the threat of significant fines if they do not follow it. That's essentially it. Much, much shorter than last time. 8 different ways that businesses can behave in an anti-competitive way. And essentially what the ACCC does to try and prevent businesses doing this, which is threaten really significant fines if they do not match that up. So I hope this is helpful. If you have any questions at all, feel free to leave a comment below or send me an email. Always more than happy to help. So this is essentially the end of this topic. I will be doing another video at another point in time to go into a little bit more depth about the modern view on consumer behavior and how things like anchoring, status quo effect, and internal biases impact consumers, because I find that's really interesting. But there's only this and one other area study in this unit. So hopefully this is going to last you a while and you'll have an assessment coming up soon, which you shouldn't be too stressed about. On that, I hope you have a wonderful day and I'll see you next time.